First thing we're going to look at, we've called it the other side of the fence, professional trading knowledge that professionals do not want retail traders to know. Some of the things you're going to see today are very harsh and aggressive home truths. And you might not like some of the things you see, but it's honest, it's truthful, and you've just got to deal with it. There's things that professional traders don't want you guys to know. So they are at an informational advantage in the financial markets versus you guys. We're going to look at some of the market participants, the broker, the educator, and the retail trader, how your side of the industry works. So basically not the professional side, and we're going to look at the differences. We're going to look at something called the inversion narrative, so why the vast majority of retail traders in the UK, Europe, and Asia lose money, and why the vast majority of retail traders in the US lose money. There's some subtle differences. And we're also going to look at charlatan educators, fake traders, how these guys create a story about themselves and suck naive retail traders into believing what they want you to believe. So I'm going to show you how to spot these guys. And then we're going to look at how you actually go about getting consistent profitability as a retail trader. So let's get started. First things first, why the hell do we care? Well, people have tried, and the vast majority lose money. But if you haven't tried, if you haven't done anything in the retail trading world, whether you like it or not, you are in the finance industry. If you participate, if you've got a mortgage, you own a business, you own a home, you've got a bank account, a credit card, a debit card, whatever, you are in the finance industry whether you like it or not. You are a participant in the economy. But there's another reason as well. Pensions. The pensions infrastructure that was essentially set up in the 70s has failed the Western world. What's the pensions question? The pensions question is, can I get income in retirement? Can I live my life in retirement? And the pension solution is to provide that income, but no one can retire. What's the average pension number in the United Kingdom? Average pension balance. It's about £30,000. In the US, in dollar terms, it's about $60,000, $70,000. In Europe, it's about the equivalent of the UK, about £30,000. So about 40,000 euros. Asia, there's varying degrees. So for example, Singapore have the highest pension values in the world. The average pension value is $330,000. But there's reasons for that, which is another lecture. But essentially in the Western world, pensions have failed. So what's happening? Boomers and Gen Xers are desperate because they know they can't retire. So people are always looking for a solution. But you've got to be warned. You're not the only people that have realized this. Everyone's realized it. And also, an entire industry has been built around a narrative to provide you with solutions to this problem. Essentially, catered to the desperate middle-class fool. Because there's a lot of bad people in the world who want to cater to the middle-class fool. And those bad people do things that are not good for you. They're only good for them. So the first thing you have to do as a retail person in this industry is to essentially make sure you have no downside. Don't do all the stupid things. Learn how basically to avoid all the mistakes. Then it's about learning how to make money over time. And this is why you have to, if you've heard of this phrase, be woke, okay? What you're going to get taught today, pretty much every retail trader will never, ever figure it out. And it's pretty simple, straightforward stuff. But most retail traders, the vast majority, will never figure it out. And even if they do, they've been on a journey where they've lost so much money to figure it out, it's now pointless. First thing you have to do when entering any industry whatsoever, if you were going to set up a new business, the first thing you would do is do an industry appraisal. Who are the winners? Who are the losers? How's the industry set up? What parameters can I operate in? How do I be successful? What mistakes do I need to avoid? If you were going into any industry, you would do that as a smart business person. Why would you not do it in trading? It's the first thing you have to do. And there's been some major trends in the last 30 years that really affect retail. And they're very important. They have significant consequences. The first one is how the market's set up. Who owns the exchanges? The exchanges is where all the business is cleared. Every time you press the button, the order goes down a pipe, through a broker, through an investment bank, to the exchange. Who owns all the exchanges? So we'll come back to that later. But the exchanges are now basically owned by a couple of companies. And by having a monopoly, they can control the market if they want to. How the market is set up, how the players must operate. Who they incentivize. Parameters like this. We'll come on to it later again. Second, technology. Obviously, technology's played a major role in the last 30 years. First things first, infrastructure. Massively increased retail trader participation. 30 years ago, you'd be on the telephone, calling a broker and just accepting the price on the phone, whatever you got. What have you got now? Well, internet penetration, internet capability, speeds, very low barriers to entry. Everyone can trade from their bedroom or their phone. Very easy access. Is that necessarily a good thing? If you have access, does it mean you're good? Of course not. Hardware, microchips, processing speeds, massively increased. And then that's affected the penetration of retail traders, much lower cost of production. Again, lower barriers to entry. Software, connectivity to financial markets, and everything being organized for you. So making life easier. None of it actually means that the trader is going to be profitable. Regulators. Every problem we've had in the financial markets in the last 30 years, the regulator's done nothing to stop it before it's happened. It's always happened afterwards. The regulator is always passive and reactionary in pretty much every geography in the world. So in 2010, one of the main instruments that retail traders use are contracts for difference. They were banned in the United States. Why? Because too many people lost too much money too quickly. Also in 2010, IB contracts, which we'll come to later. So IB stands for Introducing Broker. We'll go into the details on those later. But essentially it means that people introduce retail traders onto the broker's platform and get a kickback for doing so. They were banned in Singapore in 2010. Why do you think they were banned? Loads of bad people were turning up into Singapore, like they do all over the world, and teaching people absolute nonsense, putting them on trading platforms, and everyone was blowing up and losing their money. So the regulator, government, stepped in and banned them. And this is very typical of regulators. They do it after the event. So what does that mean if you're a retail trader? Well, history tells us, as a retail trader, you have to regulate yourself because the regulator's not going to save you. They're passive, reactionary. You'll lose all your money. Then they might change a law afterwards. Doesn't matter. You're done. You're out the game. Financial markets volatility. Volatility in all the major asset classes since the financial crisis. So 08, 09. So from 09 onwards has been crushed. What does that mean for traders? So volatility for traders is the lifeblood of a trader. A trader is a slave to volatility. Because without volatility, you don't have any risk and you don't have opportunity. And risk and opportunity are two sides of the same coin. It's called volatility. And if volatility gets crushed, risk and opportunities get crushed, which means returns over certain periods of time, over certain time horizons, peter to zero. So why is financial market volatility being crushed in all the asset classes? Well, the first main reason was the monetary policy after the financial crisis. So if you remember, the Fed was implementing QE, quantitative easing. What does that do? Guaranteed buyer of bonds, suppresses yields permanently. That feeds over into other asset classes because money keeps buying other asset classes to chase yield, which suppresses yield. So it goes all the way through the asset classes. Obviously, they stopped a few years ago, but there's other reasons as well. Technology. Why does technology and access for retail traders suppress volatility? Because there's more market participants. Why does more market participants suppress volatility? Because it increases liquidity. Why does more liquidity equal less volatility? In most cases. It means there's more willing buyers and more willing sellers at every price for an asset. Which means if you have an infinite amount of willing buyers and willing sellers, assets don't move. Create zero volatility. So this idea of trading now being like it used to be 15, 25, 35 years ago, where you can just turn up, day trade, and we used to call it scalping, is not existent anymore. It hasn't existed for a good 6-7 years. And this is why day traders have basically not made any money or lost money over the last 6 years. So this has had a huge impact on retail traders because there's less opportunities over shorter time horizons. So the professionals have totally changed their approach in the last 7 years. Why? Because professionals do what the market tells them to do, not the other way around. Now think about it like this. Euro dollar, most liquid Forex pair in the market. What's euro dollar done in the last 18 months? 104 to 113. That's been the range. What happens if euro dollar is 106 from now to over the next 250 trading days? And every day you buy it at 106 and sell it at 106. What happens? Can you make money? Well, of course not. So this idiot is going to be sitting at his desk for the next 250 days saying, I am a Forex day trader. What mistake has that person made? They've limited their opportunities because they're only trading one asset class, one time horizon, and they don't have any ability to trade anything else over any time horizon. That's the first error everyone makes in retail trading. What you have to do in your first 1 to 2 years as a retail trader is to learn how to trade everything and get yourself a proper educational foundation so you can follow the volatility or predict where it is and go where the money is. So if you're over one time horizon in one asset class and it stops working, you can shift and move. You don't define yourself by one asset class over one time horizon. And the only way to do it is to emulate what professional traders do, and that's what they've done. So on the left-hand side, we've got pretty much all the behaviors of a professional trader. And on the right-hand side, all the behaviors of a retail trader. What's the approach of a professional trader? Systematic, mostly long-short portfolio management across multiple asset classes. No narrow definition. Every trader wishes they could have an infinite discretionary mandate to be able to trade anything at any time in any way they wanted. So they can just follow where the money is.